How? Yeah, that's right. How are you now? It's James Whelan calling from the Barclay Pierce something wealth management team. You are listening to the Theory of Thing Investment podcast, and that's everything that you need to know. I realize that I'm actually recording on the wrong camera here, but that doesn't matter. It's going to be fun. Hey, I'm joined by David Scutt of StoneX. David, how are you now?
Great to be back, mate. Perfect, and I'm G'd up for a big weekend of footy.
Oh, mate, she's going to be an absolute cracker week of footy. We'll get into that in just a moment. And Heath Moss out another. We've got two South Australians on this week. Heath Moss of HLM Investments. How are you now, Heath?
Very well, mate. It's good to have more South Australian representation on here. Even though he's an adopted South Australian, but we'll take it nonetheless.
Yeah, you take him, you need him. That's it. After last week's review of South Australian steak joints went down so well, we need more. The happier, the better that we are. We've been recorded here on the 27th of September, the last Friday in September 2024. And you know what? Let's go. The Swatty stuff.
God. Oh no.
He's going good, mate. Hey, that's where it's at, boys.
I'll spare everyone the other look of myself.
Yeah. We want I'm keeping my shirt on. We want people to tune in.
What? Shows. It's the show, mate. So this is the 2005 Heritage strip.
Yeah, it's a good strip.
Which is I reckon probably only a couple of hundred of them would have been printed for the Heritage round. 2005. It's the one that I bought that day that I happened to be at the game. Also the year that they won the grand final. So pretty rare, pretty sacred sort of thing for me. And the Swans by a kick on Saturday is my predict.
Very good.
Anyway,
very good.
So you know what? Even getting. Oh, hey, yeah. Get your wakey out, Heath.
Oh yeah.
You good?
Sorry. Yep. Hang on a sec.
On three or after three?
On three. There we go.
On three. You ready? One.
Yep.
Two. Okay, that's the delay. It's good. Thank you very much.
All right.
I've got the original flavour going on again today. All right. Well, we are going to kick into it. We've got David Scutt. We've obviously had a few things that have come out from China over the week, which seem extraordinarily bullish. We're going to go into Heath Moss with his market wrap of everything else that's going on in the world, and I'm going to talk about a few things that I've seen come up over the markets as well, and then we're going to get our footy tips in. Box and dice, the whole thing is done in 20 minutes, and then it's just going to be me just getting the guns out. I suppose that's just going to be how that goes. Yeah. Oil me up and ready to go tomorrow. Okay, David, I was interviewed by a Hong Kong radio show, Carolyn Wright, who's a friend of mine from Bloomberg. She went over to an HK radio setup, which is pretty good. I think a few people do that some stuff with them. And they asked me, they said, look, the Chinese, there's some Chinese regulatory stuff that's probably going to come out, a bit of policy thing. Do you think it's going to be anything that's worth paying attention to? I said, mate, I can't pay attention to every single thing that's going to be coming out. The number of times we think they're going to be doing some stimulus for housing, think that they're going to be doing some stimulus. I think they're just going to be focusing on their tech and just protecting their tech and protecting their economy from the US. I really don't think that this is going to be anything too drastic and probably not going to be anything that moves markets too much. There's a reason I could not have been any further.
Wrong.
Like I'm not even in a panic from how wrong I was at that particular prediction. That's mate. Do you want to run us through what the ramifications are, what it's about, and what the ramifications are, please?
Yeah, look, I won't go through all the things that were cut on Tuesday, but there was a lot of monetary easing that was announced, providing more cash that the banking sector can go and release to the real economy. Policy rates, wholesale rates, everything in between were all capped by some degree. And then the question was that led to a big reaction in the markets on Tuesday. And then you could see sequentially over the coming days after that the momentum, the excitement was dying down because markets wanted to go and see some direct, forceful stimulus measures to go and try and resurrect the Chinese growth trajectory. We know that the Chinese economy has been struggling relative to what we've come to expect in the past. And then all of a sudden yesterday, we got some more detail from the fiscal side. And certainly the rumors out there at the moment, there's been nothing that's actually been slated, but a 2 trillion yuan package coming out there, about half of that to be devoted to directly stimulate domestic demand. It's not huge in the scheme of things, but it's enough to go and address those concerns that are out there at the moment. It's almost certain, even if you think that maybe the numbers are a bit rubbery, that China's going to hit its growth target this year now.
That's all. That's it. I mean, are you happy? Are you happy to be a buyer at these particular areas based on what's happened this week?
There's going to be momentum in the markets, certainly, but we've moved a long way. We've priced in a lot of good news already. And just to go back to the size of this package, so 2 trillion yuan, to go and put that in perspective, back in the GFC, it was about 4 trillion yuan. So it's half that size. Okay. And of course, the Chinese economy now is a lot bigger than what it was back then. So the one in the GFC was around about 12.5% of GDP. This one's about 1.5% of GDP, with about half of that actually for demand. So, like, from a fundamental perspective, is it really going to move the dial too much? Look, I'm still a bit questionable, but certainly there was so much pessimism priced into Chinese markets. I'm not surprised to go and see this massive move, but a lot of the adjustment, I reckon, now has already taken place.
Okay, that's it. What about the stimulations of capital markets? There was a lot with regards to, and I had an interview recently with someone. I won't say who it's from because that podcast hasn't come out yet, but we're talking about you can have a good thesis, but if the market doesn't move behind it, then it doesn't really mean anything. The Chinese, what was it for capital markets? Effectively, like loans to be able to charge into the market. Is that what they were offering?
Yeah, look, they're encouraging insurers to go. So they want longer-term players to go in there. We all know that Chinese markets are very, very heavily retail-orientated. So you get these massive swings, like euphoria and complete and utter pessimism. And it just seems to swing on a dime. And I think they're trying to go and smooth some of that out. And you're right, there are some mechanisms being put in place that will allow companies to go and borrow to go and buy back their shares. So I gather it'll be probably like very, very low-cost loans to go and buy back their own stock. At high yields and everything else. Of course, that's another positive step. But again, is it going to be something that's going to be meaningfully going to go and adjust the trajectory for Chinese corporate earnings? I'm still a little bit skeptical at this point.
There are some insanely cheap stocks out there, and the market as a whole. I think what is it trades at 9 times forward PE. If you can believe any of the numbers that are around, but that's definitely one that I think that you can back because actually that's set stock numbers. So it is extraordinarily cheap. But as I have joked in the past, that if I had $1 for every time that I thought the Chinese market was cheap and I charged in, then we'd be having this conversation on a boat, and I would have more money to be able to plow into other markets that aren't China, like India. I think that also there's a protection that China needs to have of its own capital markets because of what happened with Hong Kong. And there was a little bit of skittishness about investing in Hong Kong and that being a place where the primary market was going to be potentially do a capital raise or even do a new listing if you were going to be that way inclined. With what's happened there was a little bit of skittishness with it. I think that a lot of the US and European banks managed to fight that off and say, no, we're going to stay here in Hong Kong because it is fine. China wanting to move it to the mainland or to be the place to be, they just need to have the strength. You can't have a good capital market structure if your stock market is weak. And if the stocks that are listed on it are weak, then I think that this is part of their continuing idea of just trying to make sure they've got the market rallying, which then makes it a lot more easier, a lot of a better sales tactic to be able to get people to put their listing onto your market as opposed to just going to the obvious one, as we saw. What was the other big one? There was another Saudi Aramco. These ones, just going to the US and not going anywhere else.
Yeah. The other big thing as well, you got to remember too about the Chinese stimulus package is that they're going to go and look to recapitalize their banks. And anyone who's looked at their banks, net interest margins have been getting absolutely crushed at the moment. They've just gone and cut a whole bunch of rates as well. So they need to go and protect against that distortion in NIMs, not enough movement coming through in deposit rates as well. And there's a lot of bad debts on the other books as well. So they need to go and do that to go and facilitate the ability to go and lend if the demand comes through. But again, you've got to see that demand coming through, and that's not guaranteed at this point.
Noted. So it's obviously still a risk to the market, the Chinese property sector.
It is. It's huge. It's a huge part of the economy. I think 70% of household wealth plus is stored in property as well. So you can see why spending has been pretty weak at the moment, and through the wealth effect. So yeah, it's a positive. Don't get me wrong. I'm not going to go and poo-poo it and say like, I know it's terrible. It's not going to make any difference whatsoever. But it's still, there's still risk involved with that. You need to go, you can lead the horse to water, but you can't make it drink. And if you don't want the Chinese consumers don't want to go and buy more property, they don't want to go and buy more things. They're concerned about the outlook. Look, it's going to be a struggle. China will have to go back to the old ways of stimulating through industrial activity and the like. And we know that that can't go on in perpetuity.
All right, that's fair enough. Anything else you're seeing in the market at the moment?
Look, not really. Like a lot of the other things at the moment, gold, silver, a lot of those precious metals as well. Any commodity priced in US dollars, no yield, is doing pretty well. And then the Chinese announcement this week that came out, of course, has just gone and put a rocket under a lot of those areas. Look at what's going on when it comes to the inflation outlook. You look what's going on when it comes to the monetary outlook. It's hard not to dislike those areas there. They're all looking pretty good right now. So that looks great. Cyclicals as well. A lot of good news is priced in. So I'm still, I want to go and see a bit more price action first to go and get too excited about that front. A lot of good news is priced.
All right. Well, Heath, mate, why don't you show some charts and we can go through your market report and have expert analysis by one of us, being Adelina on this one, and I'll just sit here and just work on the gun show. Heath Moss, the Heath Moss HLO market report. Here's the market, the bacon and egg wrap.
Beautiful.
Brought to you by Heath Moss. Go for it, mate. Let's see. What do we got? You always open with the banger, don't you?
I do. You got to start with the S&P 500, don't you?
Start with a showstopper, mate. Come on.
Yeah, it's another week, another record high. US markets up, but S&P 500 for the week is up about 0.8% at the moment. You can see there tapping on new highs, although that candle looks a little bit suspect. And then when you look at something like the Nasdaq, that's up around 1.6%.
Suspect candle again.
Yeah, again, still off its highs there. The Nasdaq, the S&P 500 and Dow Jones are cracking new highs, whereas Nasdaq is still lagging behind. I think you're starting to see a little bit more a broader base in this rally. Utilities, industrials have really outperformed over the last few weeks. Whereas NVIDIA and Microsoft and that, whilst they perform well, they're sort of lagging behind. So maybe a bit more buying in the rest of the market outside of those Mag 7, as you would say, moving forward. And then obviously that's all on the back of some of this bullish Chinese sentiment over there as well. We really haven't had much macro data to speak of in the US. We had initial and jobless claims come out last night, which were a little bit higher than expected, but nothing to really turn the needle. But it's more about this sentiment of, we're in a rate cutting cycle now. How quickly those cuts will determine where the market goes and the sentiment around them. But, the sentiment at the moment is the US economy is solid. To me, I think that it's going to start accelerating into the end of the year and into 2025. We spoke about that last week. I think the US consumer is going to, their buying power and their borrowing power is just going to increase from here. Real wages are still looking really healthy. Jobs market is still reasonably healthy, and they've got $14 trillion US dollars of equity in their homes to tap into to start renovations or investing in other properties or buying a car.
I did hear the Morgan Stanley podcast this morning. They had their property expert on from Slovenia. Well, she was in Slovenia at the time.
Slovenia, wow.
Visit. Yeah, it was something like that. Anyway, I can't remember her name, but she's talking about, yes, that the property shifts over there does allow for the unlocking of more credit in households. It was exactly in line with it.
There was also some pretty big news out overnight. So usually don't pay too much attention to the final read of GDP figures, but we got the annual revision coming through. And for Q2, everyone was getting quite concerned about the US economy because the GDP income measure was sitting about 1.3% annualized in Q2 and much weaker than the expenditure measure. And people were saying, well, that's a really, really bad sign. And I know which one I'm putting more weight on, particularly if you're from the bearish side of the equation. But then lo and behold, last night it was revised up. And so now I think it's 3.3% annualized to Q2. And the really important thing that's flowed through to that is that when it comes to the household savings ratio in the States, now obviously this is an aggregate measure, but rather than being, I think it was like 3.3% of disposable income, it's been increased to 5.2%. So there's more firepower, there's more savings to go and draw down upon again, which again, when you look what's going on with some of the consumption numbers out of the States, things are looking really good on that front. So it's certainly not time to go and get really pessimistic about the US economic outlook. It doesn't look like it. The GDP now at the moment is running about 3% annualized in Q3 as well. So that's well above neutral level.
I think forecasts for next year for 25 GDP is around 4% at the moment with many. I mean, I know the Atlanta Fed just up their their GDP forecast moving forward. And like you've said, the consumer is getting more firepower. They're 70% of the US economy, give or take 5%. And if they're spending again, that economy just booms. I mean, we've seen it in the past, and it sort of, I think it could be a mini sort of pre-GFC act where people are dipping into the equities in their homes, and that really fires the economy along. Not to say that I think there'll be a GFC 2.0 afterwards, but it really, if there's a healthy US consumer, then the US economy is healthy. Doesn't matter what else happens, manufacturing anything. That's all it comes down to. And
well said.
Yes, yeah. So that's my thesis and what I'm running with moving in. And in terms of exposure here on the ASX, because you can get decent exposure, and I just spoke about this on Ausbiz. I like BlueScope Steel, James Hardie, Treasury Wine Estates, Lovisa, the jewelry manufacturers. They've all got very high exposure to the US economy and to the US consumer. So I'm backing those sorts of stocks in portfolios to help get that exposure. So so to me it looks really, really healthy. So but if we want to move on, we'll move on to the XJO, and we're tapping on the door of new record highs here as well. Obviously intraday highs were still a little bit below it, but if we closed here today, we'd make a new closing high just. But obviously the rarity this week, as David spoke about at the top of the podcast, is the China stimulus. And just to add to what David was saying, I think the equivalent today of that after that GFC stimulus, he said 4 trillion at the time. I think it would need to be 14 trillion yuan this time around for it to be the equivalent. And obviously, I think UBS said on their podcast, they're saying that this stimulus is anywhere from 2 to 10 trillion yuan. And that's a massive range, but that's what they're saying it's worth to the Chinese economy. But
right.
what I think
that's
happens,
more like it. That's some real numbers.
I think happens is this stops the rot, and what I think is more important is the sentiment behind it. Is this will change the sentiment of the consumer and the Chinese economy, and for investors over there, and build some confidence again. Because, like David said, there's been massive wealth lost in their property sector and in the stock market. I think it's 15 to 18 trillion US dollars or something along those lines in value and lost in the property and the stock market over the last couple of years over there. So it's that's soul crushing. If you're a consumer and you're seeing that your house is now worth 30, 40, 50% less than it was a couple of years ago, you're not going to go spend. But the thing, the bullishness that comes behind that is in China is when you get married, you're forced to buy a property. And it used to be that most counties wouldn't allow you to buy a second property at all. You had to get basically divorced so you could buy another property if you wanted it. Whereas those rules are all being relaxed now. The deposits for second properties have been dropped from 25% to 15%. So all these sorts of little things are going to add.
Little
and
things
I think,
just that needs to do.
I think they'll stop.
It's working in the right direction.
I don't necessarily, like Dave said, I'm cautious in terms of moving forward, but I think we will see more stimulus come along. It may take another 3 or 4 months. They'll sit back and see what effects this stimulus has on the economy, and whether it starts to see green shoots, and then they'll go again. But the rhetoric and the language and the commentary used by the PBOC and the government over this week has been very, very bullish and very positive. And I think that's the main thing to take away from it is they are now ready to step in and really support this economy and almost do. I heard someone compare it to the Draghi moment in the early 2000s, whatever it takes.
Whatever it takes, mate. It's
whatever
it takes. If I'll tell you what, if you get compared to Mario Draghi, you're in pretty good company out there, mate. That's, Sorry, David, what were you going to say?
Not really. Not too much to go to add to that. The one thing was it was really noticeable in the communique from the Politburo was that they were talking about the counter-cyclical factor. Now, I don't want to get too wonkish, but they talked about the need to go and be more forceful in the counter-cyclical adjustment when it came to not only monetary but fiscal. So to go and back that out into like what it means in layman's terms, it means we're going to go and juice it more. That's what it means. And so some of the more cautious commentary that came out of the Politburo earlier this year looks like it's gone for the wayside for the time being.
So
that's all right.
So quickly, just to drag that back to the XJO, obviously we've seen resources perform really, really well this week. Up until yesterday, they're up 6.5%. Probably add another couple of percent to that today. The financials are down 4%. So you've seen that rotation from financials into resources. And I flagged this in August, and I think as early as July,
I said, heard you.
And I wasn't I wasn't forecasting this sort of stimulus from China. It was a valuation basis. I said, it's time to move some of that money out of financials into resources. They look way too cheap here. In my 20 years, generally when this sort of sentiment comes around, this is close to a bottom. Lo and behold, we get this sort of stimulus come along, and BHP's moved from $38, $39 to 44, 45. Fortescue from 16 to 20. All the big guns, South 32 from $3 to 350, are performed well. Now, to say, I don't think this has much more legs outside of this initial move. I think they will plateau or come back a little bit from here, because the market will eventually want to see results. Plus, we've got that election on the horizon that will cause some volatility in markets. But I think this is the start of another bull run for the commodity sector. Like I said, I expect more from China. If this doesn't work, more from China. That will get things going again and commodity prices going again, et cetera, et cetera.
All right. Well, we're on a hard stop. We're on a hard stop here at 11 o'clock, Heath. So
right, no worries.
I need to see aluminium. I need to see copper.
Well, there's copper.
And I need to see iron ore if you can show it too.
Big move in copper there. I think that's around 6 or 7% move in copper for the week. What are we? Iron ore really hasn't done much. I think that's the Singapore. Yeah, that's the Singapore futures.
Yeah, Singapore's still hovering around that 90 spot. It did. It did pop up over 100 apparently overnight, though. I think, didn't it?
It's trading over 100 now. It's over 100 now. Technically, it looks all right, but yeah, fundamentally, the Politburo did say they're going to go and restrict new property builds, and that's the biggest source of steel demand globally. The residential sector. So I'm with Heath. I think commodities look really good, but you got to be selective. And iron ore, to me, this move we're seeing looks a little bit speculative in nature. I wouldn't expect it would last. I'm investing by hope at this stage. Anyway, it's fine. I need iron ore. I need iron ore to go higher. Anyway, keep it going. What's the last one? Aluminium.
And that's aluminium. I don't think I can bring it up on here. I think I've tried before. It doesn't allow me.
Oh, we've done that before, haven't we?
But but
it's sort of petered out.
Yeah,
I mean, shortages at the LME for aluminium, and it was looking amazingly good there.
And I just want to quickly cover oil. Some really bearish news coming out this week is the talk is Saudi Arabia will abandon its $100 barrel of oil target and is going to concentrate on market share. So that means basically the last time they did this was 2014, I think it was, and they dumped a shitload of production into the market. Sorry, excuse my French, but a lot of production.
I got to put a special disclaimer on the podcast now. Thanks, Heath. I got to click a little box now to say that there's rude language coming out of the South Australian contingent. Thanks a lot.
That's what we're all about here. Crush the price and sort of trying to gain that market share back from especially US producers where shale, a lot higher production costs, around $70 to $75 a barrel. So they want to do that again. They'll increase the production and crush those prices to get market share back. And obviously short term, that is bearish. Still longer term thesis. If things start going again with China and the rest of the world, then oil and energy looks really, really good. But short term, we could see that price head towards 60 or lower again if they decide to do that. But so I don't think it's been confirmed yet. I think that's the talk at the moment. So that's it.
That's it.
Yeah, that's it. That's it. That's all I'm going with.
That's all you're going with. Okay, that's fine. Hang on, I was going to have... I had a window. Yeah, I had a window. That one there. All right, that's my tweet of the week is... Can you see that?
I'll stop sharing. I need to stop sharing. Okay. There we go.
You've taken yours off. Can you see my one that's there?
It's a blank screen, mate.
Well, you're a blank screen. What are you talking about? It's a blank screen.
You need more Ethernet cable.
It's fine. I need some Cat 6 on this one. What do you mean it's not? It seems fine. Hang on.
No, I can only see a blank screen here. It's a dark black screen. So
you're a dark black screen. Here we go. I've stopped that sharing. Anyway, I don't know what's going on. I was just saying that Barron's came out with there you go. That'll work now. Barron's came out. You probably can't see that now. I think about it. No. Anyway, Barron's just come out with the headline: "The stock market is having a melt up. There won't be a meltdown anytime soon." And I was just thinking, oh, great. Thanks a lot, Barron's. Well,
thanks for calling on the top.
It's been an honor. It's been an honor serving with you guys. We're all going to die now. That's it. Thanks very much, parents. Also, a big congratulations to Eunice Wong, aka Eunicorn, who was awarded
Buying a dip.
crypto influencer of the year at I think it was some token conference up in Singapore just recently. Her absolute smash hit by the dip is
busting out on the charts.
Yep.
Mm.
Anyway, we all know that song. I'm not going to play it anymore, but I wish her all I wish her all the best on that one. Anyway, good on her for that one. A few other things sort of popping around. I'm seeing through the Twitter sphere around here as well. Assets in money market funds have increased 126 billion with a B since the Fed's jumbo size rate cut and hit a record 6.76 trillion on Tuesday. That's coming out of Crane data. An extraordinary peak on that one as well. In other news, Apple has silently, this is from Matt Lozak. In other news, Apple has silently now included, and we haven't mentioned this yet, say it quietly, otherwise the people will freak out. Nuclear. Apple has
I saw that.
included nuclear in their definition of clean energy. We've had a joke about the clean energy side of things in the past, Heath. But look, nuclear is now part of their clean energy process, and kaboom! Chinese banking stocks, 142 billion going into that as well. Finally, what have we got here? We've got a classic snarky, a bit of a complaint here from one of the punters.
Oh no!
Someone on Twitter has had to pay $7.30 for a service fee for a $10 ticket to the New South Wales Cup final.
Mm-hmm.
What an outrage!
It's a joke. It's a joke.
It's an absolute joke.
What service? Did they go and type the address for me? I don't know, but honestly, like when you talk about blatant rip-offs and productivity inhibitors, boom, right there. That's one of them. That stuff should be cut out.
It's ripe for disruption, and the fact that it hasn't been disrupted by now is painful to me. The fact that this is taxis waiting for Uber to come, and it hasn't hit yet. All right, guys, give me some footy tips, and then we'll go.
All right, you go first, David.
Look, I'm usually a pretty nervous Swan supporter, but I'm feeling good. Like I'm feeling really good, actually. Like I think we're going to win. I think we're going to win convincingly.
Thanks,
I wouldn't be surprised if we win. I'll say by 28 points. Swans by 28 points, and probably Warner, Norm Smith for the AFL, and my beloved North Sydney Bears playing the Newtown Jets, going back a long time here since we last went and played in the grand final. I like them, but it's going to be a super tight game. 4 points for the Bears.
Bears played in last year's grand final, David, the New South Wales Cup. Not in the NRL.
And they got beaten there by they got beaten in the last 2 minutes, and
they got beaten by the Bunnies in the last one. They got a lot to prove this year, mate. It's going to be sensational. What have we got here? So this is my guy that gives you the best plays. Sydney line. What have we got? -3.5. Take that you can get. 2 interstate teams. Read more. Keys to the game. Best bets. Norm Smith. The big 3 from Sydney. Heaney, Golden, Warner. Neil is the obvious choice for Brisbane. Value is Sydney. Papley, $21. Blakey. Papley, $21 for the Norm. Interesting. Chuck that in.
Well, small forwards tend to do well in grand finals. We saw Bobby Hill last year win it for thing. So
anyway, I'll take Sydney 1-39 and just load up there. The total 170.5. No play. Agree with the market. So yeah, they're not doing anything. First goal scorer, Papley. I'll tell you what, if Tom comes out and just with that and just fires the boys up when they need to be fired up, it's going to be a great afternoon. I'm looking forward to it as well. Anything else from the boys? And then I'm going to wrap up.
I am taking the other side of the coin, boys. Sorry, I think the Lions 1-39, $2.55. Bank that. I think they're the team to be. They're just riding on confidence, given their comebacks all throughout the final series. I think they look good here. 1-39, $2.55. And Cam Rayner for the Norm Smith, $18. I think he is a big time player. We saw him in the last quarter last week. I think he can do it again, kick 3 or 4 goals and pick up 20 possessions and win that flag for them. So and if you like the NFL, I think the Bills to beat the Ravens at $2.10. Bills are on fire at the moment with Josh Allen. So
good.
Have a look at that.
Okay, good. That's all I've got. Thank you very much for that, guys, for helping us out. David Scutt of StoneX, mate. Thanks very much. Go Swans.
Yeah, go Swans, go Bears, and great to have been here.
Yeah, no worries at all. And thanks very much, Heath Moss of HLM Investments too.
Thanks, David, and let's hope it's just a good game and not a blowout tomorrow.
It'll be all right. You have been listening to the Theory of Thing Investment Podcast. Any questions or comments, send them through, and I'll be able to take care of that for you, either by responding or ignoring you. Thank you very much. My name is James Whelan, Managing Director of the Barclay Pierce Capital's Wealth Management Team. I hired a new guy. We've got a new guy starting on Monday, a New Zealander. Looking forward to that coming in. Really helping. So you can add 1 to the employment rate as of Monday, which is good. So I'm helping the economy. We grow. We keep on growing, which is fantastic since I kicked in. So thanks very much, guys. Have yourself a good weekend. Go Swans, and have a good one. See you next week.
Have a good one, everyone.
Yep.